If you're building a digital business from India today, your revenue relies on the routing of cross-border data. Every time a customer clicks buy, you need that international transaction to clear and land in your bank account. For years, if you were an Indian founder locked out of Stripe, you likely defaulted to one specific gateway for international sales, 2Checkout, which now operates under the Verifone brand. On a technical level, the product works. It processes payments across more than 200 countries and handles dozens of localized checkout methods with established compliance. But underneath that reliable tech stack is a pricing architecture that disproportionately penalizes businesses domiciled in India. You are paying premiums simply because of where your company is registered. We are going to audit the hidden cost of running 2Checkout and then map out the specific modern alternatives you should use based on your business constraints. 2Checkout's published baseline rate is 3.5%, but there is a massive gap between that headline number and the actual amount of capital that lands in an Indian bank account. Take this $5,000 international transaction. Right off the top, that 3.5% base fee is deducted. Because you are an Indian domiciled seller, virtually every international payment you receive triggers an additional 2% cross-border fee. Next is currency conversion. 2Checkout applies a 2 to 5% forex markup, averaging about 3%, layered on top of the daily interbank exchange rate. Finally, they do not pay out in Indian rupees. Your funds arrive in USD, euros, or GBP, forcing your local bank to convert the currency, taking another hit of about 1.5%. When you add those layers together, you're looking at a 10% effective cost. On a $5,000 sale, $500 is gone before the money reaches you. If you are selling digital goods or subscriptions, this stacked fee structure erodes your profit margins. For domestic sellers, the platform's math is structurally flawed. Transaction fees are only the first part of the problem. Scaling businesses also face a secondary systemic drag on their liquidity. This waterfall chart shows the rolling reserve. Out of a $50,000 monthly stream, 10% of every sale is diverted into a locked chamber. By month 3, $15,000 are trapped before the first month's funds are finally released. In practice, this functions as a mandatory, interest-free loan you are giving to your payment processor. That locked capital has consequences. This is the cash you would otherwise use for engineering hires, ad campaigns, or your working capital buffer. After all, early-stage businesses scale on usable liquidity. Theoretical revenue sitting on a dashboard doesn't pay your immediate bills. A 90-day reserve policy effectively holds your own operational growth hostage for a quarter of the year. To bypass those bottlenecks, you need infrastructure engineered for Indian businesses billing internationally. That brings us to Playto Pay. Their pricing model removes forex and cross-border markups. You pay a flat 4% on international cards and Apple Pay, and 1% on virtual bank account transfers. They also automate compliance by generating a foreign inward remittance certificate, or FIRA, on every transaction, which is required for local GST filing. Looking at this side-by-side matrix, the difference in fees is immediate. On that same $5,000 transaction, 2Checkout pulls about $500 in total fees. Playto Pay takes $200. There is a trade-off to consider. Prioritizing these flat margins and local compliance means sacrificing support for some fringe regional wallets found on legacy platforms. But if your priority is protecting profit margins and eliminating administrative friction, a direct flat fee processor is the most cost-effective path. What if your business model requires global tax handling or B2B enterprise logic instead of just direct settlement? In that case, you look at a merchant of record or More model using platforms like Paddle or Dodo Payments. A More offloads the burden of calculating and remitting global VAT and GST. You pay a higher baseline rate, usually around 5%, in exchange for offloading that tax liability. The limitation for Indian sellers is that payouts stay in USD. You still need third-party tools like Wise to route money home, which adds forex hits and transfer delays. Finally, there is the option of forming a US LLC through Stripe Atlas to unlock standard payment processing rates. This path offers a 2.9% base processing rate, but as the visual shows, that low rate is balanced against heavy legal compliance and thousands of dollars in setup costs. Operating a US LLC from India introduces dual-country taxation, mandatory state filings, and annual maintenance fees. Offshore entity creation is justifiable only for high-volume enterprise sellers. You need enough transaction volume for the fee savings to outweigh the upfront legal costs. Let's eliminate choice paralysis. This diagram outlines the exact routing protocol you should follow based on your model. If you are a digital creator who needs direct daily payouts and automated FIRA compliance, route your business to Playto Pay. If you are an enterprise SaaS founder processing high B2B volume and can handle the entity work, use Stripe Atlas for the lowest long-term rates. If you want a processor to handle software VAT and global tax liabilities in 100 different countries, use an MOR like Paddle or Dodo Payments. If you rely heavily on local UPI traffic but still want to process international cards on a single dashboard, Razorpay International or Cashfree will fit your needs. Remaining on 2Checkout is only advised if a large portion of your revenue relies on legacy markets where modern Indian alternatives have no coverage. Select your payment infrastructure based on your transaction volume and where your customers are actually located. Aligning your infrastructure means revenue moves to your bank account as fast as you earn it. Stop fighting the processor. Start using the capital. As an Indian founder, stop defaulting to punitive legacy systems out of habit or a perceived lack of access. Audit your landed revenue and verify how much capital is trapped in your rolling reserve. If the math doesn't work, initiate a migration. Choose the payment partner that acts as an engine for your cash flow, rather than a 90-day holding cell.